Alrighty. Today I'm gonna go over a little bit about fiscal and monetary policy. So this is the last lecture, and I thought I'd give this a share. No one's showing up in office hours here, so I thought I'd use this as a Zoom lecture, and I'll post this up for you to prep for the final exam here. So I'm going to talk about the difference between fiscal and monetary policy. All right. So what you see is a picture of here. This was at the time President-elect Obama, Vice President-elect Biden, and on the right you see Rahm Emanuel. He showed up in the documentary Panic. He ended up being Obama's chief of staff, and then behind him, or to the left of him, a giant of a man. That's actually Paul Volcker, who was the former Fed chair and passed away. And on the right hand side, that's a picture of the Capitol. And I use that to represent fiscal policy. All right, so what is fiscal policy? It's a spending, or it's a means by which the government adjusts its spending levels and tax rates to monitor and influence a nation's economy, right? So that's the textbook definition of fiscal policy. Again, don't confuse that with monetary policy. Monetary policy is the Federal Reserve's changing of interest rates to influence money supply. Remember, those are kind of the two big things of this kind of unit, fiscal policy and monetary policy. All right, so again, the two types of fiscal policy are as follows. You have expansionary fiscal policy, right? This is used to encourage growth in a recession or prevent one. And there's two things that you can basically do. You can either increase government spending or decrease taxes. This is the very popular thing to do if you're a politician, to promise to increase Medicare spending, Medicaid spending, or to decrease taxes. President Bush's signature campaign issue was that he wanted to lower taxes, and he accomplished it, and it was known as the Bush tax cuts. Obama's signature initiative was Obamacare, where there's an increase in government spending. So again, that's just kind of one of the things that the government can do on the fiscal side now. Now, the unpopular thing to do would be contractionary fiscal policy. So this is when sometimes the government wants to slow down growth. There's two things that you can do. You can either decrease government spending or increase taxes. Again, this is not something that you campaign on. And if you do, you're going to find ways to say in a way where you're not actually increasing taxes or decreasing government spending. You don't want to say this because it's very politically unpopular to say that you're going to cut someone's Medicare or if you're going to increase taxes, right? So again, these are the two types of fiscal policy that we're dealing with here. All right, so here's a quick question. Which of the following is a fiscal policy action aimed at reducing unemployment? Is it A, decreasing government expenditures, B, decreasing income taxes, C, decreasing tax credits, D, increasing nominal interest rates, or E, increasing required reserves? Okay, the answer for this is most clearly going to be which of the following? It's going to be decreasing income taxes, right? Because the idea is that if you want to reduce unemployment, you're going to have to use expansionary fiscal policy, right? And when you decrease income taxes, then you're expanding the economy, right? All right. So kind of continuing on. A fiscal policy action to reduce inflationary pressure would be to increase which of the following? Is it A, the required reserve ratio, B, the discount rate, C, transfer payments, D, government spending, or E, income tax rate? So for this one here, you can eliminate right off the top of the bat A and B here. So we're going to go over this, I guess, later here. But required reserve ratio and discount rate, these are monetary policies. So that makes it wrong. Now, this is the opposite of expansionary. This is contractionary, right? So if you increase which of the following, is it going to contract the economy? So if you increase the income tax rates here, right? So if you increase the income tax, it's going to reduce inflationary pressure, right? So the reason why C and D are wrong, if you increase transfer payments, that's like Social Security or Medicare, then that's going to increase inflationary pressure. If you increase government spending, that's another expansionary measure. So the answer is E, increase income tax rates to reduce expansionary um, inflationary pressure. Yeah. All right, so let's move on to yet another question. Which of the following statements is true about an expansionary fiscal policy, right? Uh, it decreases demand for loanable funds. B, it decreases the equilibrium price level. C, it decreases the equilibrium interest rate, real interest rate. D, it increases aggregate demand, or E, it increases the money supply. All right, this one might be a little bit, what does it mean for demand for loanable funds, right? But I'll tell you this, A, B, C are going to be incorrect. Demand for loanable funds, if the government's going to uh, spend more money, it's going to have an increase in loanable funds. And then the price level is going to increase because there's going to be an increase in aggregate demand. And consequently, there's going to be an increase in the real interest rate. So the answer for this one, it's going to increase the aggregate demand. So if the government's spending more money, then there's going to be more of an aggregate demand for the entire economy. Now, E sounds like a possible answer, but remember, fiscal policy deals with government and taxes and not money supply. That's going to be monetary policy. So again, I think the key for this unit or this set of reading is to differentiate between monetary and fiscal policy. Yeah. All right. So let me kind of give you a little breakdown of the different types of philosophies um, within economic theory here. So you have classical economics. So up to now, we've been learning a lot about the idea of the free market, right? So the person most associated with the free market is actually Adam Smith. So this is the idea that free markets regulate themselves. He wrote a book called The Wealth of Nations, where he observed a pin factory, and there was a lot of specialization. So a lot of things that we do, doesn't require any government intervention. So this is, again, the idea that government should not intervene in the economy. But there's a criticism of classical economics. And the main person that was against this was a guy by the name of John Maynard Keynes. He quoted, or he said that in the long run, we are all dead, right? So during the Great Depression, the idea of what the government should or should not do came into play, and around that time, the Great Depression marked the turning point where the government took a little bit more of an active role in the economy as opposed to the laissez-faire, hands-off type of economy, right? So what is Keynesian economics? This is the idea that the government should try to reach productive capacity or full employment output, using the full arsenal of monetary and fiscal policy. Again, so this Great Depression mindset, when the country's suffering, it became more of the norm for the government to take an active intervention, right? And so there's four sectors of the economy that Keynes broke down, and they were, individuals, businesses, government, and net export, and it was reduced down to this equation: y equals c plus I plus g plus nx. So now, just to make sure not everyone kind of agrees that you could reduce the entire macroeconomy into an equation, but that's kind of what macroeconomics is. I mean, this is when I teach AP macro econ, you have to memorize this formula: y equals c plus I plus g plus nx. But there are some people that may disagree that that's putting too much emphasis on the role of government in the economy. All right, there's something also known as supply side economics here. So supply side economics is the idea that economic growth can come from businesses rather than necessarily from the consumers. So this is when you lower taxes. It's going to spur an increase in economic activity. So Ronald Reagan was kind of a proponent, at least, maybe not in all the things that he did. He did raise taxes during his administration, but one of the first acts that he did was to lower the marginal tax rates. And again, he's a believer in supply side economics. Those that don't believe in supply side economics would call it trickle down economics, or even voodoo economics, right? So George H.W. Bush actually called supply side economics voodoo economics, insulting Reagan's signature economic platform. And so he insulted Reagan. And what do you do if you're running for president and your opponent insults you? Well, you make him your vice president, and that's exactly what Reagan did. Now, what's kind of interesting is that George W. Bush, whose dad was obviously George H.W. Bush, um, you can make the argument that Bush tried to continue the legacy of President Reagan rather than his father, George H.W. Bush. So even though W, he admired his father, he would probably he wanted to model his presidency after Reagan and not his father, George H.W. Bush. All right, so one of the things here, you have the Laffer curve. So what the heck is a Laffer curve? This is kind of the graph behind supply side economics. This is the idea at 0%, you're going to have zero tax revenue. But if you raise the tax rate to 100%, then you're also going to have 0% tax revenue. So if the tax burden is too high in an economy, when you lower the tax, you're going to actually have more economic activity, right? So that's the theory behind that. This was postulated by a man by the name of Arthur Laffer. So again, this Laffer curve. Is a tax cut going to increase total employment so much that the government collects more in taxes, or is this just voodoo economics? Yeah. This is a scene from Ferris Bueller's Day Off. So if you ever have seen the movie, I definitely do recommend it. The writing in the back, it says monetary and fiscal policy. And what's kind of fascinating about this clip is that it was not scripted. Ben Stein came up with these words. He was slated with the task of being a boring economics teacher, and he nailed it brilliantly. This was actually his inaugural role as an actor.
In 1930, the Republican-controlled House of Representatives, in an effort to alleviate the effects of the Great Depression, passed the the tariff bill, the Hawley-Smoot Tariff Act, which raised tariffs in an effort to collect more revenue for the federal government. Did it work? Anyone know the effects? It did not work, and the United States sank deeper into the Great Depression. Today, we have a similar debate over this. Anyone know what this is, class? Anyone? Anyone seen this before? The Laffer curve. Anyone know what this says? It says that at this point on the revenue curve, you will get exactly the same amount of revenue as at this point. This is very controversial. Does anyone know what Vice President Bush called this in 1980? Anyone? Something DOO economics. Voodoo economics.
All right, that's Ferris Bueller's Day Off and his explanation of voodoo economics here. All right, so that's a very short recap of fiscal policy. Now we're going to talk a little bit about monetary policy. I like showing the next couple slides. It's not a lot of text here. I'm just kind of showing you a history of the U.S. currency, because when you talk about monetary policy, you have to talk about money, right? And so this is in 1934. You had $1,000 bill, right? And this is President Grover Cleveland on the $1,000 bill, right? He's the distinction of being the only president elected to non-consecutive terms, the 22nd and the 24th president. So he graced the $1,000 bill, right? And if you think, well, I've never seen a $1,000 bill, I mean, that's crazy. Well, the reason why you don't see an existence anymore, there's no demand for this currency, right? I mean, people probably don't carrying around a whole lot of $100 bills. Can you imagine in 1934, having $1,000 bills? Just the demand wasn't there. So eventually they took it out of circulation. But if you really did want to buy $1,000 bill, you can easily go on eBay, and they're available enough as a collector's item where you could buy $1,000 for probably around $2,000. Right? What's more rare is the $5,000 bill. This is the $5,000 bill, and if you guys notice, the person on the $5,000 bill is the father of our Constitution, James Madison, the fourth president of the United States. But again, the same rule applies. If you're not going to hold on to a $5,000 bill, then or you're not going to hold on to $1,000 bill, why are you going to hold on to a $5,000 bill? These are definitely more rare, but you might see these on eBay. They're about eBaying, auctioning off for about $10,000 as a collectible. Please don't go shopping with this and get change. Much more valuable as a collectible item rather than as a source of currency. Right now, doesn't stop there. You have the $10,000 bill, and this is actually not a president. This was actually Abraham Lincoln's Secretary of Treasury, Salmon B. Chase. He actually wanted to be president, but he was the third. He was the third Republican in the 1860 nomination. First was Abraham Lincoln, and then second was William Seward, and then third was Salmon B. Chase. And if you ever heard the book Team of Rivals by Abraham Lincoln, it kind of chronicles the biographies of Salmon B. Chase, William Seward, among others, and obviously Abraham Lincoln. Interesting, Abraham Lincoln did not have the most positive things to say about Salmon B. Chase. He didn't really rely on him like his Secretary of State, William Seward. All right, and then there was actually $100,000 bill. This was not circulated amongst the general population, but this was more of a bank transfer note. But even still, $100,000 bill, not something that you would want to have a whole lot of here. And this is President Woodrow Wilson on the $100,000 bill. All right, so there are three functions of money. They're medium of exchange, unit of account, and store of value. So what does money do? It's anything that's used to determine value during exchange of goods and services. So the first function of money makes it such that we don't have to barter for things. So imagine if you had to barter for things. You go to the mall. You go to the mall to buy something, and if you didn't have money, you have to bring something of comparable value to exchange for what you want. So that would be a little cumbersome to do that. A unit of account, use it as a measure to count. So if you're trying to compare between a $70 sweatshirt versus an $80 sweatshirt, well, money serves as a good means of a unit of account. You can kind of compare the value of goods and services. And then the third function of money is a store of value, right? So money, if you hold on to money, then the idea is that you want it to maintain its value. In-N-Out burgers would make for terrible money, right? Primarily because if you try to hold on to In-N-Out burgers, it would rot, right? So countries where there's hyperinflation, then money doesn't serve as a good store of value because it's going to lose its value if you hold on to it, right? All right, so what backs up your money today? You see some bright gold in there, and no, we are not on the gold standard. We used to be, but we got off the gold standard in the early 20th century, and then we got completely, we got off the gold standard after World War II, but we got completely off the gold standard in the early 1970s. So gold is a commodity you can purchase, but you can't go to a bank and ask for a fixed amount of gold. There's no modern country today that does do that here. There's a person that ran for president in 2008 and 2012 as a Republican, also in 1988 as a libertarian candidate for the president. And if he were president, he would actually return to the gold standard, which would be very difficult to do in today's modern economy. But again, he is a strong advocate for return to sound money. All right, so again, 1913, the federal government established the Federal Reserve System. Now, a lot of people think that the Federal Reserve is a government institution. It's not. It's a private bank, but there's a public component to the Federal Reserve. All right, so I'll explain that a little bit later, but there's something called the money multiplier formula. So again, my concern is for you to understand monetary policy, right? So if you deposit a certain amount of money into the bank, then money will multiply. I mean, not literally, but the actions that people take and the required reserve ratio of money will increase, right? So for example, if you deposit $500 into a bank and the RRR is 0.10, that deposit has actually created 500 divided by 0.10, and it's created actually $5,000. Now, what the heck? How did it create $5,000, right? Well, what happens is that you take that $500, the bank lends out 450, 90% of that money. The person deposits 450 and they lend out 90%. If you go through that process, then the more money you deposit into the bank, as long as you don't withdraw it, then more money would be created, right? Um, so that's kind of the idea behind the money multiplier process, right? Now, the Federal Deposit Insurance Corporation, if you're worried that your the money in your bank is gonna, go under if like a bank fails, then there's something called the FDIC that insures the depositor. So it insures the money that you put up to a certain amount. Now, it actually used to be $100,000, but they actually raised that to $250,000, right? So, if you see the FDIC insured in your bank, then you can save up to that amount. If if the bank fails, then you're protected by the deposit, right? All right, so uh, monetary policy here. So let's talk about contractionary monetary policy. So if there's too much money floating around the economy, and the goal is to take money out of the economy, then the Fed will use contractionary monetary policy, right? So why would they want to do that, right? So you take money out because you want to get less inflation, but the downside is that you're going to you might also get unemployment, right? So the Fed video game that you played, whenever you raise the federal funds rate, then the goal is to get less inflation. The bad byproduct is that you also get unemployment, right? That's contractionary monetary policy. Now, expansionary monetary policy, the goal is to put more money into the economy because the goal is to get more employment. But the downside is that you also may get inflation. So again, in that Fed Reserve video game, if you lower the interest rate, the unemployment level goes down, but your inflation is going to go up. And so for every good thing, then there might be a bad thing as well, right? So as the Fed they're in charge of monetary policies. They have to determine what to do. Now, with this COVID crisis going on, one of the first things that the Fed did was to lower the federal funds rate down to 0%. They lowered the federal funds rate. So they bought bonds to get that down. And so that was an expansionary move. So how long are we going to be in this expansionary mode? Probably for a good chunk of time. I don't see the Fed raising rates anytime soon during this COVID crisis, right? But again, the structure of the Fed, the leadership, there are 7 officers, although they're not all filled at the same time. So I believe there's only 5 members right now that are filled right now. So it takes a president to appoint and the Senate to approve, right? So each with 14-year terms. The current Fed chair is Jerome Powell. What's interesting is Biden has nominated to be his Treasury Secretary former Fed chair Janet Yellen, right? Now there's 12 districts. We are in District 12, right? So the FOMC, they're the Federal Open Market Committee. It consists of all 7 members of the Fed and 5 rotating bank presidents. Although the permanent seat, actually, there's 4 rotating and 1 permanent member, the president of the New York Fed. Now, in the Panic documentary, Timothy Geithner, he was the New York Fed president, bank president, and him, Ben Bernanke, and Hank Paulson, they're the ones that kind of were the trio that uh, President Bush relied on during the initial part of the financial crisis right now. So again, the current chairman is a guy by the name of Jerome Powell. And that's not Jerome Powell. I just didn't change the picture. That's actually Ben Bernanke, Professor Ben Bernanke. Again, his background was a former econ teacher at Princeton University. There's good old Jerome Powell, appointed by President Trump. All right, so there's some Trump tweets here where I put this in there because Trump had appointed Jerome Powell, but there are certain things that he did, namely that he didn't lower interest rates, right? And again, the politically popular thing to do is to use expansionary monetary policy, buying bonds and lowering interest rates. And because he didn't do that like immediately, now once COVID hit, he did that. Trump had some issues and tweeted out some nasty things about Jerome Powell, right? And so that's what he did. Um, there you go. So, but one of the things he appointed Jerome Powell, and he didn't reappoint Janet Yellen uh, because Janet Yellen wasn't one of his original appointees. Right now, in terms of Jerome Powell's appointment, most analysts called that to be somewhat of a conservative move. It wasn't like an off the wall pick; it was kind of a boring pick, right? And uh, again, Fed chairs, they hold 4-year terms. Should be interesting when the position comes up again for President Biden to appoint a new Fed chair. Is he going to reappoint Jerome Powell, or is he going to go with his own person? All right. So what is the federal funds rate? The federal funds rate is the interest rate in which banks lend money to other banks overnight. So that's the interest rate that you were adjusting when you played the Fed Reserve video game, right? So again, it's not the interest rate at which the Fed lends to a financial institution. That's the discount rate. Okay, so the discount rate is the interest rate that the Fed charges the banks, whereas the federal funds rate is the interest rate that banks charge each other, right? And so the Federal Reserve, they actually set the target federal funds rate. And if they want to raise the target federal funds rate, they'll sell bonds. If they want to lower the target federal funds rate, they're going to buy bonds, right? Uh, all right. So this is kind of a history of the effective federal funds rate since 1955. And again, you see like during the financial crisis. So let me go ahead and zero in 2008 during this financial crisis, all the way up until like 2015, the effective federal funds rate was down to 0%. And once the economy started recovering, Janet Yellen and Jerome Powell, they started raising the federal funds rates until coronavirus hit, and they dropped it all the way back to 0%. So right now we're in a very historically low interest rate environment, right? So money is very cheap comparatively. Look at the late 1970s when you had the federal funds rate, which was the Federal Reserve led by Paul Volcker, who was featured in the IOUSA documentary. He made the unpopular move to raise the federal funds rates up to nearly 20%. And so he did that because inflation was raging in the United States. And so he raised the federal funds rate. And, for the most part, inflation was tamed in the United States. Yeah, again, not the most popular thing to do, but what's popular and what's effective are two different things here. All right. So, what are the tools of monetary policy? Open market operations. So, I like to use the word B for bloatage and S for shrinkage. So, if the Fed buys government securities, they're bloating the economy with more money. If the Fed sells government securities, then they're selling. They're shrinking the money supply by selling government securities. Right. Again, this is tied to the federal funds rate. But just think of B, buy, bloat the economy, sell, shrink the economy. Right. All right. So again, the money's going to the people when the Fed buys government securities, and it's bloating the economy, right? When the Fed sells securities, then the money's going to the Fed, and the money supply is going down here. Okay. There's a uh, there's there's an episode in Seinfeld where George Costanza is talking about shrinking the money supply, and that's a clip I played here. All right. So another way the Fed expands the money supply is to decrease the required reserve ratio. That's the amount of money that they have to hold on to your bank deposits. If they increase it, then they're using contractionary monetary policy. And then federal funds rate, I mean, this really should be discount rate, but I just put federal funds rate and discount rate. together. Anytime you lower the federal funds rate or discount rate, that's increasing the money supply. Anytime you raise it, you're decreasing the money supply. So you put money in by either buying government securities, decrease reserve ratio, or lower the discount or federal funds rate. And then if you take money out by selling government securities, increasing the required reserve ratio, or raising the federal funds rate here. So again, once again, that's how you put money in. That's how you take money out. Again, you're not actually physically doing that. You're either using open market operations or you're using ratios in order to achieve your objective of the right amount of money in the economy. Right. So um, yeah, these are this is kind of an interesting one here. I'm not gonna play this here, but in 2012, you see here Rick Perry laughing here and Ron Paul laughing because in 2012, Rick Perry made a comment if he were going to um, reduce the government spending, which is contractionary fiscal policy, what he would do, right? And he said there's three things that he would do. He would cut three departments. It would be education. Um, he would cut education, commerce, and he couldn't name his third one. Right? He didn't realize that the third one that he actually wanted to eliminate was the Department of Energy. Right? So rather than saying energy, he said, "Oops." That pretty much derailed his candidacy, and Mitt Romney became the Republican nominee. It's kind of sad, but it's actually what happened, and it kind of tanked his presidential aspirations. Governor Rick Perry of Texas here. Yeah, so that was a real sketch. This is a real thing, and one of the things I do show here. This is the Saturday Night Live version of what happened. All right. All right, so that's pretty much it here. Other than this, I think I have a couple more questions here on contractionary and monetary fiscal policy here. So to counter a recession, the central bank might pursue which of the following actions? Is it A, increasing reserve requirements? Okay, stop right there. Anytime you increase reserve requirements, that's contractionary. So this is definitely wrong. Yeah, definitely wrong. I'll use red here. It's definitely wrong. And selling government securities is also contractionary. Increasing capital gains tax. Okay, that's wrong right there because that's fiscal policy, not monetary, right? And also selling securities is gonna be contractionary as well. You want expansionary. Decreasing reserve requirements, yes. But increasing the discount rate, no, that's wrong. That's counterproductive, right? So it can't be C, even though the first part is right here. Decreasing the discount rate, yes. Buying government securities, yes. These are both expansionary, right? So these are both expansionary. So that would be the correct answer. But just for making sure, is E the correct answer? Decreasing the capital gains tax. All right, that's expansionary fiscal. And then selling government securities, okay, that's contractionary monetary. So the answer to this is D. When the central bank decreases the discount rate and buys government securities, that's expansionary monetary policy. Okay. All right, and another question here: which of the following combinations of policies is designed to decrease inflation? All right, so this one here is kind of a tough question here, but let's take a look. An increase in taxes, is that going to decrease in inflation? Yes. A decrease in the reserve requirement? No, that's not gonna. That's expansionary. You're looking for two contractionary. So this one here is wrong. An increase in taxes? Yes. An open market purchase is gonna be expansionary monetary. So the first part again is right. Increase in taxes, but an open market purchase would be wrong. A decrease in taxes, no, you know what? That's going to be expansionary right there. An open market purchase, again, that's expansionary as well. An increase in government spending, again, that's going to be expansionary. And a decrease in the discount rate, that's going to be expansionary as well. So even without looking at E, E is the correct answer. But let's see why E is the correct answer. Um, a decrease in government spending, that's contractionary fiscal policy. And an open market sale, selling government bonds, that is also contractionary. So E is the correct answer on this one here. So this one would probably be a little bit more difficult than the prior question because this requires you to know both monetary and fiscal policy in order to get this question right. All right. All right. Another question here. Which of the following combinations of fiscal and monetary policies will correct a severe recession? So you want to use expansionary fiscal and expansionary monetary policy. So which one's expansionary? Increasing income. No, 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 no. That's contractionary. Now you decrease the money supply. Yes. Increasing both the income tax rate. No, no, no. That's contractionary. So you're going to make the recession worse right here. Again, increasing the money supply is a good thing here, but no. So again, actually decreasing the money supply will make the recession worse. Decreasing the income tax rate, yes, but when you decrease the money supply, that's no good. Decreasing income tax rate and increasing the money supply. Now, how do you increase the money supply? You either buy bonds, you lower the required reserve ratio, or you lower the discount rate. So D is the correct answer. Very good. And let's see why E is wrong here. E is wrong. Decrease the income tax rate, that's good. But when you increase the federal funds rate, that is contractionary. So D is the correct answer. Again, I would consider this to be one of the hard questions on your final exam and one of the harder questions on your final quiz. So again, this is something, if you want to outperform on your final exam, then you're going to have to study a little bit more and kind of absorb some of this information here. All right. So again, I actually haven't updated this since 2013, but the national debt is closing in on $30 trillion. So that's, I don't know if that's an amazing accomplishment or whatnot, but again, the debt was supposed to increase to 19.6 trillion by 2015. So at this rate, when is the debt gonna just continue to explode? Probably, but again, that's not on the radar right now for politicians, especially with coronavirus and returning the economy to normal. But again, this is an issue, and the debt to GDP ratio is above that troublesome 100% here. All right. So again, if you want to see the current debt clock, go to usdebtclock.org here. All right. So I'm going to end it right there. So this was my lecture of monetary and fiscal policy. And that's it. Have a great day.